This 10-second check turns fair value gaps from guesswork into high probability areas. Most fair value gaps look the same. Price makes a big move, leaves a gap in the middle, and returns back. But only some fair value gaps are actually backed by real participation. The rest are weak and fail fast. You won't see the difference on a naked chart. You have to measure it. In this video, you'll learn exactly how to filter out weak fair value gaps within seconds using a secret tool. But before setting the tool up, it's important to understand the foundation behind it. So what exactly is a fair value gap, or FVG? It's a 3-candle pattern. Candle 1 marks the start of a move. Candle 2 is the large impulse, where price moves aggressively in one direction. Candle 3 comes after the impulse. For the fair value gap to qualify, the wicks of Candle 1 and Candle 3 must not overlap. If they do, there's no gap. In a bullish FVG, the high of Candle 1 sits below the low of Candle 3. In a bearish FVG, the low of Candle 1 sits above the high of Candle 3. This creates a price range that was skipped, an imbalance. That gap represents an inefficiency, a pocket where there was no two-way trade. Markets often return to these areas to fill them before continuing. The catch? Not every fair value gap will hold. Some get filled instantly, others get ignored. And until now, there's been no way to measure which ones are backed by real participation. That uncertainty is what makes fair value gaps tricky to trade, but there's a way to cut through it by looking at what actually happened inside the gap. That's where this indicator changes everything. If you want to follow along, you can load it up right now on TradingView. It's completely free to use. Just go to the Indicators tab, search for Fair Value Gaps Volumetric, and click this one by Flux Charts. There'll also be a link in the description. This tool does everything a normal FVG indicator does. Plots the gaps and marks the levels. But it also goes deeper. When a gap forms, it measures the total trading volume across the 3 candles that created it, and then splits that volume into 2 parts. The volume driving the move in the gap's direction, and the volume moving against it. In a bullish FVG, bullish volume is the combined volume from the impulse candle and the candle after it, while bearish volume is from the first candle before the impulse. In a bearish FVG, bearish volume is the combined volume from the impulse candle and the candle after it, while bullish volume is from the first candle before the impulse. This breakdown helps reveal whether the imbalance was fueled by real market participants or just noise. The indicator then displays both the total volume and the percentage split. This breakdown helps reveal whether the imbalance was driven by conviction or just noise. The indicator also displays a percentage for each gap. This number tells you what portion of the total volume inside the gap came from the smaller side or the side going against the gap's direction. A lower percentage means most of the volume was pushing with the move that created the gap. In a bullish FVG, that means strong buying pressure and strong selling pressure for a bearish FVG. These are generally the higher probability gaps because they were formed with real market participation, showing clear intent behind the move. A higher percentage means a larger share of the volume was going against the move. This signals weaker support from market participants, making the gap more likely to break or fail when price returns. Before we look at any real chart examples, we need to walk through the indicator's settings. How you configure this indicator determines whether you're just plotting fair value gaps or actually finding the ones worth trading. Here's how to dial it in. First, under zone invalidation, choose wick or close as the condition for invalidating a zone. Wick means the gap fails the moment price cuts through the far side. Close means a candle has to fully close past that side. Next is the zone filtering. This is what determines how the FVGs are filtered, so you avoid low probability gaps. There's 2 methods to choose from. The first method uses the average true range, or ATR, to measure recent volatility. ATR tracks how large candles have been over a set period. If the average range is small and a large fair value gap suddenly appears, the script can flag it as a standout and plot it. The second method is the volume threshold. Instead of measuring candle size, it filters by how much trading activity actually happened. The script only shows gaps where the total volume is above a set percentage of the recent average. You can adjust the number used with the volume threshold percentage setting. So if your threshold is 150%, it will only plot gaps where the volume across the 3 candles that formed it is at least 1.5 times the average. This way, you're only looking at gaps backed by real market participation, not random, low volume moves. Once you've set your filtering method, the next control is the actual fair value gap detection. You can choose between 2 options, same type and all. With same type, the indicator only detects fair value gaps that are formed by 3 bullish or bearish candles. And with the all option, the indicator will find gaps where the 3 candles don't all move in the same direction. For example, you might see a large bullish candle in between 2 bearish ones, and this will be plotted as a bullish fair value gap. The next setting is detection sensitivity. This controls the minimum size a gap needs to be before it's plotted. If you turn this setting off, the indicator will show every possible gap it finds, even the smallest ones. If you enable it, you can choose between low and extreme. Low only plots the biggest gaps, while extreme catches even the smallest ones. The other options fall in between, letting you decide how much detail you want on your chart. The last setting lets you choose whether to keep historic zones visible after they're invalidated, or hide them so only live setups show. Everything else, from colors to labels, is fully customizable. That covers every setting in the indicator. Now it's time to see how the indicator works in the real world. We'll walk through 2 trade examples, and you'll see how to spot high probability fair value gap setups using this tool. We'll start with a bullish trade. We're on the 1-hour Bitcoin chart, and price is in a clear uptrend, creating higher highs and higher lows. Now that we've confirmed the higher time frame is bullish, we'll look for a long entry on the lower time frame. Dropping to the 5-minute chart, price breaks through a key resistance level and forms a bullish fair value gap. The indicator shows high total volume inside the gap with a low percentage reading, confirming strong buying pressure. When price pulls back into the gap, we enter long. Stop loss goes just below the broken resistance with a 2 risk-reward target for a clean, calculated trade. Now let's flip it. Same process, but this time, the 1-hour trend is bearish, with lower lows and lower highs. On the 5-minute chart, price breaks below a key support level and creates a bearish fair value gap. The volume inside the gap is high and the percentage is low. This indicates that sellers are in control. Once price pulls back into the gap, take a short entry. Place the stop loss above the broken support level and target a 2 risk-reward trade. So that's the process. Start with the higher time frame to confirm the trend, then drop down to a lower time frame to pinpoint the setup. Use the volumetric data to filter out the weak fair value gaps and focus only on the ones backed by real market participation. If you only had this indicator, you'd already be ahead of 90% of traders. But the price action toolkit takes it even further. It detects multi-timeframe volumetric fair value gaps, so you see where real participation aligns across 3 time frames instantly. It auto-plots order blocks with volume confirmation, detects real-time market structures, draws trend lines, and so much more. You can get instant access at fluxcharts.com. That's all for the video. If you found it helpful, please hit the like button, subscribe for more trading breakdowns, and drop a comment below telling us which indicators you want to see next. Thank you for watching, and until next time.